ladies and gentlemen. Welcome to our indexuniverse.eu webinar, Sectors via ETFs, Which Funds Should I Buy? This webinar is sponsored by Deutsche Bank, DBX Trackers. The content in the slides that follow is looked after by us, indexuniverse.eu. I'm Paul Amery, the editor of indexuniverse.eu and the Journal of Indexes Europe. I'm joined on today's webinar by Michael Schneider, who's head of ETF and ETC sales in Europe at Deutsche Bank, by Russ Wermers, who's associate professor of finance at the University of Maryland, and by Irene Bauer, a partner at 2020 Investments. A reminder to everyone listening in that you're encouraged to and you're able to submit a question at any time during the next hour. All you have to do is to type your question into the Q&A box or the Q&A window on the lower right-hand corner of your screen and click the send button. During the second half of the webinar, during the last 30 minutes, we'll be taking your questions, passing them to the panelists, but you can send in your questions at any time as we go along. The agenda for this afternoon is, first of all, Russ Wermers is going to talk about sector-based strategies in general from a top-down perspective. I'm going to spend 15 minutes talking about sector indices and sector ETFs, and then we'll move on to the question and answer session. And with that, Russ, I'll pass the controls over to you.
Thank you, Paul. I appreciate that very much. Good afternoon, everyone, from relatively sunny Washington, D.C. metropolitan area. This is where the University of Maryland is near, if you're not aware of where we're located. It's great to speak to everyone today about the strategies, the sector strategies, and at Prolly Capital. Okay, who is Prolly Capital? Prolly was a brainchild of an academic partner of mine, Dr. Alan Timmerman at the University of California, San Diego. Alan is, if anything, probably one of the world's best, or at least the world's foremost forecasting experts, econometric forecasting experts. Alan is well known for writing models dealing with predictability of stock markets, of asset classes, and other related things. And Alan and I, about 5 years ago, a little bit more, got together and decided I had a paper in the Journal of Financial Economics that discussed how to use macroeconomic variables, kind of a top-down approach, to select actively managed mutual funds in the United States. And the procedure of using macroeconomic variables in a top-down approach actually has had and still has applications to all sorts of universes of products. And so today I'm delighted to discuss what we found in terms of its application to ETF sectors. Now, everybody here knows about the capital asset pricing model, and I'm not going to discuss that. That's where kind of modern finance started, and since then we have all worked with expanded risk factors such as style, growth, value, market capitalization, momentum. These seem to be very widely used factors now to describe asset class returns, sector returns, and so on. Our value added, our innovation is the final box in this slide, is that we incorporate in a formal quantitative model macroeconomic factors in order to use these macro factors in a top-down approach to forecast sector returns. And what we found is that this is a very well-predictive system. We do not do data mining. We base everything that we do in this model on peer-reviewed academic research, as well as our application of that. And as you'll see, the model has solid mathematics behind it, and I hope that you get a chance to take a look at the research behind it. Now here is sort of a graphic that describes kind of the mixing pot, the melting pot, if you will, of our model. In graphical form, I'll show you just a touch of mathematics in another slide, but I didn't want to overwhelm with that because the math is sort of easy once you see this graphic. So our model takes sectors in this example. For example, construction, basics, technology, utilities, and the goal here is to forecast which of those sectors is likely to be the most promising right at the moment with current interest rates, short interest rates, dividend yields, term spreads, and default spreads. And I might add again that these 4 macro factors were not chosen based on data mining, based on trying hundreds of factors. These were factors that were macro factors that have been used very widely by many famous academics, well-known academics, such as John Campbell and Campbell Harvey, currently editor of the Journal of Finance, to forecast asset class returns. Our innovation here is that we place these macro variables in a formal model along with risk factors, and use the macro factors to predict both where the risk factors may be going, but more importantly for our discussion today, for where we can see outsized returns in excess of the risk factors in each sector. So our goal here, very simply put, is to find sectors that outperform other sectors, or expected to outperform other sectors based on the current macroeconomic environment. Here's a touch on the mathematics, and really what I want you to focus on today is that second term, that alpha with the prime sign, I1 times ZT minus 1. ZT minus 1 is the today's known level of macroeconomic variables. As you remember in the slide before, that was the default rate, short rates, the term spread, and the dividend yield. And so what we're trying to do, this is indeed just a factor model you might recognize. And so the factors, they're the Fs that are in the rightmost 2 terms, are the risk, the market factor, the size, style, and momentum factors. This is because we are working with U.S. sectors, and these are the factors that seem to describe returns differences in the U.S. Equity markets the best. Again, let me focus you on that second term. The second term basically is our innovation with this product. The fourth term is as well, but I'm not going to discuss that today. The second term basically says that in addition to the first term, we might be able to find time-varying mispricings in sectors that are predictable with the macro factors. So basically, think about the first term in this equation, the constant alpha. We wouldn't think, and generally it's true, that sectors don't have alpha. That's generally true, as we can't count on a sector to have alpha. Kind of by their very nature, they're very efficiently priced over the long run. The idea of the second term is that we may be able to find sectors that, based on the current level of macroeconomic variables, are expected to outperform, even if it's only temporarily. That's what that second intercept alpha I1 prime times ZT minus 1 is capturing. So what we do is we model this. We take each sector and we use its past history of returns. Generally that's 3 to 5 years. We measure correlations using this equation, and there are a couple other equations I'm not showing you here that describe the evolution of risk factors and the evolution of the Zs, the macroeconomic factors, and these things capture the time series properties of those, but those are secondary in importance to the one I'm showing you here. For each sector, we estimate this equation based on the monthly rates of return of the sector, and we recover the alpha 1 prime. The alpha 1 prime is basically the past correlation between that sector's outperformance, if you will, and the level of macroeconomic variables measured at the beginning of a particular month. We then use that fitted model to forecast forward what, based on current economic conditions, using those 4 macro indicators that I mentioned to you, which sectors are likely to outperform, which would be the alpha prime multiplied by the current level of macro variables, which are likely to be most positive and which are forecasted to be most negative, and all the ones in between. And we, instead of weighting as you might normally do among the sectors, and in this example I'm going to show you the results for versus an equal weighted sector portfolio, we weight them in a rank weighted manner. I'm going to skip this slide because this is merely the results for some global sectors. I'm going to go right to the U.S. equity macro results. Here are those rank weights that I described to you. So our top ranked of the 10 sectors in the U.S. is assigned an 18% weight, all the way down to the bottom ranked sector, which is assigned a 2% weight. You can see on average there's a 10% weight on each sector, so we're going to compare this to the equal weighted sector portfolio return. Here are our benchmarks. Again, I already described those to you. The macro factors, here I've added a couple more. We have inflation, we have consumer sentiment, and we have industrial production. And we also have an indicator for market sentiment. And what we mean by vintage series is that these variables are very carefully measured. They're very carefully recovered, such as inflation in industrial production, to reflect what was known at that time. So they don't include revisions to inflation or industrial production in order not to bias the analysis. Here are the results of this procedure of applying that equation I showed you, rank weighting the top, looking just at the top 3 in this case, which is the green line, and the bottom 3, which is the violet line, relative to an S&P 500 equal weighted from year 2000 to 2011. And hopefully you can see there that the outperformance seems to be quite dramatic. Here I show you the information ratio. The rank-weighted strategy that I mentioned, going from 18% down to 2%, when we use the model in that fashion, and here we're rotating each month, we're re-estimating the equation each month, applying it, holding it forward in an out-of-sample fashion in those weights of those sectors for the next month, re-estimating the model at the end of that month, going forward yet another month, and doing this through that 2000 to 2011 time period. The rank weighted is the bar to the left. It has an information ratio of 1.21 relative to the second to foremost to the right bar, which is the S&P 500 equal weighted, which has an information ratio during that time period of 0.86. So fairly consistent outperformance. And then this final graphic I want to show you here just shows that over time, here are the allocations to the different sectors that resulted from applying the model. You can see maybe if you count the number of peaks per year, there are 12 peaks per year or 12 points per year. That's because, again, this was a monthly rebalanced, monthly recomputed optimization technique. I want to show this graphic to close, mainly to show that the sectors, the model does not jump in and out of sectors in a rapid fashion. So that's good to hear. The second thing, it lends some credibility to the model as well as some concerns about excessive turnover. The second thing that I wanted to note about this graphic is that it does make some turnovers of sectors during 1 to 2 year time periods. And that's important to know, that it's not just finding some problem with the risk model and loading up on one and only one sector for the long run. So these kind of a beautiful little graphic here, but it tells you many things about the strategy that I think gives us some confidence in the strategy. And with that, Paul, I turn control back over to you.
Thank you very much, Russ. Very interesting presentation. We have a question from one of the members of the audience, which I'll ask you to respond to when we get to the Q&A part. But I'd like to follow on from Russ's presentation by talking in perhaps a little more descriptive way about sector ETFs and sector indices, how the indices are put together, what ETFs tracking them are available in Europe, and looking at fund flows to describe what's been going on over the last year or two. Let's start with a pretty broad question. What is a sector? We'll then move on to industry classification standards, look at sector index construction, look at the available European sector ETFs, and then, as I said, focus a little bit on recent sector flows within the European ETF market. So sector-based classification systems, speaking generally, these attempt to group companies or those companies' equities based upon common factors affecting their performance. So some of these factors are macro, such as the ones that Russ has just been referring to. There could be growth in GDP, inflation, interest rates, energy prices, sensitivity to currency changes, demographic trends, or some of the other indicators that we've just heard about. There could also be some structural factors affecting particular industry sectors. Technological change may be boosting one sector at the expense of another. Accounting standards in a particular sector, business models, again, across a sector, or M&A activity, again, focused on a particular group of companies. So broadly speaking, an ideal sector classification system would achieve high correlation between sectors that have common drivers, for example, energy companies and utility companies, or energy companies and basic materials companies, but it would also achieve low correlation between sectors whose primary business activities are pretty unrelated. So energy and financials might be a good example of sectors that have intrinsically low correlations. The most commonly used sector classification standards are the ones set out on this slide. So we've got the Global Industry Classification Standard, often referred to as GICS, which is patented or owned by McGraw-Hill, the parent company of S&P, and that's broadly used by both S&P and MSCI for their sector indices and products based upon them. The ICB Industry Classification Benchmark is part of FTSE, and that's used by that company, by Dow Jones, and by stocks for their sector benchmarks. There's also the Thomson Reuters Business Classification System, which has no ETFs currently tracking it, but offers a slightly different perspective on things, as we'll come to see in a moment. Let's take the GICS versus the ICB. These are the perhaps most commonly used sector classifications. You can see 4 levels of classification. At the top level, 10 in each, but as you go further down the scale, GICS has a greater level of granularity, splitting things into 154 sub-industries than ICB. And at the bottom of the page, you'll see that we've noted that GICS has a broader range of tracker products based on it in the US and globally, whereas ICB has a greater range of tracker products in Europe, which again we'll come on to a little bit later when we look at the available ETFs for investors based in Europe. GICS sectors versus ICB industries, that's the top level classification, the first level on the previous slide. Broadly speaking, these are similar. So energy in GICS corresponds to oil and gas in ICB. Some of the sectors have the same, or industry classifications have the same names: utilities, financials, healthcare. There's an interesting, let's say, lack of matching at the consumer level, which we'll come on to in a second. But broadly speaking, top-level classifications are pretty similar between the two systems. But let's look at where they don't match and give a couple of examples. Well, where they don't match, you can see that the GICS has 2 top-level sectors called consumer staples, consumer discretionary. ICB has a category called consumer goods. And let's take, for example, two companies in the ICB consumer goods sector, British American Tobacco and Louis Vuitton. Well, GICS puts those in two separate buckets. BAT goes into consumer staples, Louis Vuitton goes into consumer discretionary, and so there's an interesting question arises. Stop buying luxury goods, which I suppose would be, if your answer to that is no, you might want to classify these two companies slightly differently. So it's worth being aware of these differences between the sector classifications. Some more examples and differences in classification. Let's take Amazon as an example. Very high-performing stock over the last decade. But is it a discount store, which is the Thomson Reuters classification, a broadline retailer in ICB, or an internet retailer, which is what GICS calls it? Should airlines be under travel and leisure, which is ICB, or under transportation, which is in the other two classification categories? Coal companies, one classification, GICS calls them energy, ICB says basic materials. So some differences there in approach. Looking at numbers of securities covered, GICS, although as we said earlier, has a greater granularity of subcategories, I think 150 compared to 110 or so in ICB, it actually covers a smaller number of securities, around 46,000 worldwide, whereas ICB and the Thomson Reuters classification have 74,000 stocks. Obviously, from a product perspective, indices with a greater range of coverage may be better diversified. They might be more suitable for use as a benchmark, but that they might also be more difficult to track, and that's something we can come onto in the discussion. This is something we've calculated at Index Universe, looking back at I think 10 years of history. We've looked at correlations between sector returns using the three different classification methods, GICS, ICB, and TRBC. And what we've done in this table is to highlight in green where correlations are above 0.8 or 80%, and correlations below 0.5, where sectors are less highly correlated with each other, are highlighted in red. And as we mentioned earlier, if you look in the three different tables at the correlations between industrials and, say, basic materials, which you'd expect to be highly correlated sectors, that's definitely the case in all three classifications. It's 0.85 at GICS, 0.87 in ICB, and 0.92 in Thomson Reuters. But taking another example of relatively lowly correlated sectors, let's take financials and energy, which is one we mentioned earlier, or financials against oil and gas. That's 0.59 in GICS and 0.59 in ICB, but as low as 0.31, which is highlighted in red in the Thomson Reuters classification. So this is perhaps a useful starting point. We're looking at combining sectors in an overall portfolio. And now we look within the sectors and look at the correlations between stocks within individual sectors. And here we've taken two different categories of consumer companies and looked at how highly the companies within those sectors are correlated with each other, also looking back over 10 years. And the further to the right a score is on the x-axis of the bottom charts, the greater the level of correlation between stocks within a given sector. That's something we identified earlier as a desirable feature of a good classification system. And you can see that over the course of the period of this analysis, generally speaking, the red line, the Thomson Reuters classification system, has achieved slightly higher intra-sector correlations in these two particular cases than the other two. When it comes to constructing investment products which are based on sectors, one needs to look at the representativeness of the sectors, but also at concentrations within the sectors. And using market capitalization for selecting sector constituents and then for weighting them can result in heavy concentration in certain industry areas. A good example, I think everybody or most people will be familiar with, was when Volkswagen shares shot up in price in late 2008 as a result of the short squeeze. And I think in October 2008, that particular company's shares got to about 2/3, I think 65, 66% by weight of the Stocks 600 automobiles and parts sector. Now, given that in Europe, ETFs that are tracking individual indices are supposed to adhere to the UCITS diversification rules, which typically and 40, and that's a 10% limit on an individual constituent. You can see that it's easy to get well above the concentration limits for a UCITS compliant fund, and so there are a variety of either capped sector-based indices. S&P, MSCI, and stocks all have variants that cap individual security weightings. There are also some other ways of doing this. Stocks, together with one of the European ETF providers, Source, has gone further and looked at so-called optimized sector indices, which deal both with concentrations but also at the ease of borrowing of the underlying stocks. And so there are certain variants of basic market capitalization weighting that have been developed in order to make sector-based indices more suitable for tracking. Here we look at Europe-listed sector ETFs by geographical exposure and by issuer. The issuers on the left-hand side and the geographical exposures or exposure to geographical equity sectors given across the top of the chart. You can see that European equity sectors are well represented by different ETF issuers in Europe, so there's a good range of choice for investors to be aware of. One thing worth pointing out is that while stocks is the most commonly used sector index provider in Europe by many ETF providers, Amundi and Spider go with the MSCI European equity sectors. Looking more broadly, geographically, we're looking outside Europe. Deutsche Bank has also got a range of emerging markets equity trackers based upon MSCI emerging markets sector indices. Lixor has some in Asia, which are also sector-based. There are a number of ETF providers offering exposure to global equity sectors. DBX trackers, Lixor, and Amundi all have global equity sector ETFs. And there are some equity ETFs listed in Europe that are based on US equity sectors offered specifically by Lixor and Source. So there's a pretty good range of equity ETFs available for investors in Europe wishing to invest using sectors. A couple of slides from Deutsche Bank's market review, 2011 market review and 2012 outlook, showing what level of participation there's been, or what level of interest has been in sector ETF investing. In 2011, we can see that inflows into defensive sectors, domestic cyclicals, and global cyclicals were all positive. So there's been a growing interest by investors in investing in a sector-based way. One thing that's notable from this chart is that cyclicals had a lot of interest earlier in the year, but then as we saw following April last year and concerns that the Eurozone crisis might spill over into the economy, there was a big switch from cyclicals into defensives. And looking at a more granular level at some of the sector ETF interest, this is again for 2011, a similar story for financials in the early part of the year. So again, for all these sectors, net cash flows during the course of the year were positive, indicating investors putting more money into sector-based ETF strategies. But whereas financials were the key area of interest during the first half of the year, cash flows dropped away, or there was some disinvestment in the late summer, and then they ended up the year at a lower level of net investment than they were in the summer. Whereas some of the other sectors picked up later in the year, notably utilities. And that brings us on to the question and answer session. We've already had a question coming in, which I'll pass to Russ shortly. But Michael, perhaps I could start with you. One thing that's been particularly common, I know, in Europe as opposed to the US market is widespread use of swaps, so swaps written between a bank and an investor to track sectors, and perhaps less widespread use of ETFs in the past in Europe, whereas in the US market, sector investing via ETFs has been much more popular. So what are the pros and cons, generally speaking, of using sector ETFs versus sector swaps in Europe specifically?
Probably to start with, it's not just the pros and cons that are responsible for this. One of the things that you have to keep in mind is that the ETF landscape in the US has started way ahead of Europe. So Europe is pretty fast catching up to where the US is, but we're still a couple of years behind in terms of the development of ETFs as a product. Now, on the one hand, the swaps have been used in the past, especially by institutional investors, to a very high degree because there was just no other format available. The ETF usage as a whole has sort of become mainstream in the past couple of years, and that was mostly done on the big, broad indices, and we're only seeing now that the granularity is becoming much more pronounced in terms of where the investors want to go. So they're actually breaking down from the major indices into single countries and especially sectors. So the sector part is fairly new. In terms of pros and cons, I mean, obviously the pros of a swap is that they are, from a price perspective, they are less expensive than ETFs would be. What do you give up for that? You have a full counterparty risk on a swap, whereas an ETF is actually a fund. In a swap, in the case of a swap-based ETF, it's usually at least 90% collateralized. But if you look at the providers out there, it's usually either over-collateralized or very close to 100. So the counterparty risk is mitigated very strongly. And then one of the other issues is that you have far more flexibility if you do an ETF, because usually a swap runs for a fixed period of time, and if you want to get out of it early, you have to pay some form of breakup fee. Now in an ETF, you can do intraday trades, you can do short-term trades, so you have a little bit higher fees than you would have, or less pickup versus the index than you would have on a swap. On the other hand, you gain quite a lot of safety with it, plus you're going to get a little bit more flexibility out of it, just in a nutshell.
Okay, and just to pick up on one of the points you mentioned there, you talked about people moving away from equity exposure based upon geographical definitions of markets more towards sectors. Now, how can you give some figures to clarify that? Because we've seen sort of general inflows into equities. Yes, what's the relative popularity of sector-based ETF investing as opposed to people buying country indices or global equity indices or emerging markets globally?
It's still on a very small level. So if you look at the overall volumes in the sectors, it's not quite as in the US that people are using them in very much sophisticated ways and models yet in a big way. What we do see is that people want basic resources exposure, or they want financials exposure, or exactly the opposite, that they don't want financials exposure or don't want a specific sector. So if you're looking at themes that are being played, you actually have a specific view on a sector and you take it as a one-off, so it's not really playing them relatively against each other very much. Problem with ETFs on the sector side that we're seeing is because they're fairly small, the amount of money you can put into one ETF without owning a big bulk of it is still limited. So it's a question until they really reach critical mass. The usage will remain fairly muted, but we do see a very much an increased interest in the sectors, and we're seeing more and more people shifting away just from a country focus, because what we saw in the last couple of years was, if European financials are hit or US financials are hit, it's basically more a global thing, and it'll hit all the single countries. So you can't escape financials by going to Germany rather than Italy or France, because they tend to get sold as a whole. So that movement has really led to people looking more at the sectors. Now, in the past, it was more a hedge fund type playground, if you like, if you look at the sectors, and now it's becoming more mainstream. More people are developing models on the sectors, and one of the reasons why we're seeing more popularity in sectors is because the correlation between the single stocks within the sectors have become very high. So the question is not, which bank do I want to own? The question is, do I need banks at all, or do I need utilities at all? And they basically get sold as baskets now rather than a single stock. So I see it more as replacing, on the one hand, the single stock pick, and on the other hand, it's just bringing more granularity into the overall broader indices because they're available, but they're fairly new versus the rest. So the broader indices have been around for always in ETF format in Europe.
Okay, Irene, let me turn to you because you've come from index development and a research role at BlackRock to your own investment firm, and I'm intrigued to hear what your thoughts are in terms of putting together an equity portfolio. What role sector should play when doing that globally.
Yeah, I think as Michael has said before, one problem is, of course, that there isn't as much money in the sector ETFs yet, especially within Europe. I mean, for example, if you look at the European-based sector ETFs, I think they have been around the most, and that's usually the ICB classification. So you have 19 ETFs. So if you have player in sectors that have around 2 billion, then on average you only have around 100 million per ETF. And for an institutional investors, and that is more a play for the institutional investors, that is kind of the start when they are thinking about investing in those ETFs. Yeah. And therefore it hasn't picked up as much as one would like to. And I think I also agree there are probably not that many out there that just do pure allocation on sector rotation. Yes. But it's more like when there is a downturn, I want to go more into the defensive sectors. Yes. So on top of wanting or not wanting allocation to Europe, for example, I might prefer the defensive sectors. And so I think it's very much, there can be a fair amount in the ETFs for a while, but it can leave the ETF fairly quickly as well when the market turns. Whereas so it's a bit of a chicken and egg situation currently when it comes to the European sector. Whereas if you look at Eurostoxx 50, where we have so many ETFs out there now in Europe, the money usually just, or a lot at least, does stay in there, whatever the market does, because there are always some who would like to invest in that area already because there are lots of strategic allocations. Yes, and that in itself then generates a certain level of trading volume and headline liquidity as a result. Exactly, and that then makes it very much a building brick for your portfolio. Yeah. Whereas if you don't have that liquidity yet, then of course that's the that's a problem for all the investors to entry, and that's always the problem when you start with an ETF. It has still low AUM. It's very hard to get to that 100 million kind of threshold when then the institutional investors really come in, and then suddenly it starts picking up. Yeah. So some interesting sort of internal market dynamics there, which hopefully will be overcome. Russ, can I ask you a question about your model? I see you've had a couple of questions which you've on some quite technical inputs which you've been answering. But one thing that wasn't entirely clear to me from your presentation was, I understand what the inputs are to your macro alpha model, but when it comes to expressing the actual results you come up with in a portfolio, to what extent can that be done purely through equity sectors, or is this just a part of the output? Is the sector part of the output or is it just part of the output, and you're doing other things through bond equity weightings and different currencies and different asset classes? How does it work in terms of the model output, and to what extent are sectors used there?
Yes, thank you, Paul, for that question, and thank you, Alexander. Basically the question is about what in this particular application of the model. I was working only with the 10 S&P sectors, and I didn't allow a cash position. But in other applications of the model, which we show on our website, which is Prolly.com, and if you look in that website under strategies and then under fact sheets, you'll see we have white papers on the application of this strategy to several different areas, including multi-asset classes, commodities, currencies, and so on. So in that particular, basically the model, the top-down model using macroeconomic variables to forecast some type of security or sector or asset class return is a very general one, and in this case I apply it to sectors. So hopefully I've understood your question.
Yeah, yeah. Thank you for clarifying that. One thing that came to mind, Michael, in your earlier comment, something I wanted to ask about hedge fund use of sector ETFs and use of sectors on the short side. In preparing for the webinar, I found a comment in an article that 17% of hedge fund short positions in the US market are made by ETFs, and a lot of those are actually sector ETFs. So people hedge fund investors are buying individual stocks but using short sectors as a kind of hedge. Yeah. Whereas in Europe, there's a much smaller use of short positions in sectors by hedge funds. So, what are you seeing there? Is that becoming increasingly popular? What are the impediments, if any, to more widespread use of sectors for hedging purposes and for short positions?
Yeah, well, to start with, at least in the last couple of years, the really interesting things to short were financials, and there were short bands on them. So that was a very difficult thing to do. Yeah. But apart from that, if you look at the way or the regulations in Europe, if you want to short something, you have to lend it. And if you want to, if you lend it, then you can actually more or less have a covered short. Now, the lending industry on the European ETF side is still very limited. So there's no real established infrastructure on lending in place. There are one or two players that are in that, and I know of a couple of funds really using or sort of hedge sectors being created to be shorted. But as a whole, it is actually a fairly limited part, and one of the reasons is really that if you're not a regulated or UCITS regulated, then you can actually use the US stuff. So it's easier to lend something in the US or short something through the US than doing it through Europe. And unless you regulate it in Europe, you're not going to do it here. You're going to do it there. On the other hand, it's very hard to short sectors in a big way if there's not much assets in them. Yeah. So it's also a chicken and egg type of thing. I mean, if you want to short a DAX, there's probably 18 billion just in two of the dollars in two of the big DAX ETFs. So you will find stock somewhere, but trying to find stock which is fairly scattered, and you have sort of average AUMs of probably 25 million for sector ETFs across the board, you're going to have a very, very hard time getting somebody to lend you the amount that you may want to short. Right. So that is one of the things. I think it will pick up once sort of the overall sector part does pick up. But as I said, it's sort of a question, and what Irene's also alluded to that already. You need to get that critical mass threshold before an ETF really takes off, and nobody tends to be want to be the first to go in big size. So people sort of chisel in piece by piece, and once you get big, then the applications around the ETFs become far more diverse.
And I think you've also got the broadest range of inverse sector ETFs listed in Europe. Presumably the same questions of the availability of the underlying stocks for shorting and concentrations and so on would affect the pricing of those inverse ETFs as well.
The pricing, but the interesting part there is you're going to be it's going to be the stock available on single stock level. The lending has to be there. Whereas short a whole sector, the overall ETF has to be there. So unless you create short, you're going to struggle. Now on the short ETFs, we've actually seen some of the volumes being bigger than on the long sectors, because basically what you would find is that somebody who's running a stock 600 and is uncomfortable and has that as a benchmark, but is uncomfortable with financials, for instance, or is uncomfortable with utilities in an upwards market, you can actually sort of strip that out of your broader index. So you can do a little bit of fine-tuning on the index, and there they did seem to be quite popular. Now, on the long side, unless you look at things like equal weight sectors and then you short the market against that, which is basically a similar thing to what the hedge funds are doing in the US with shorting the market and going long single stocks. You're just playing the relative value or stripping out the alpha. Once that becomes more mainstream, you're going to see it. And it's one of the things where we see a lot of people doing work at the moment is in these sort of creating alpha with beta type problems to products to get relative value alpha out of sectors or out of sort of an equal weight type strategy.
Oh, okay. Thank you very much for that. I mean, Irene, what are your thoughts on the short versus the long side of investing? I mean, would your business's perspective stretch to taking long short views? Do you have any views on whether it's better to hold sectors long or short, or how best to put together relative value trades?
I mean, at 2020 Investments, we don't really short any ETFs, so we just work on long-only strategies based just solely on ETFs. But, I mean, for a hedge fund, I think the source ETFs, they have a new innovative idea where they just selected or removed the stocks that you can't short easily.
Yes.
And so they created a new index, and with that you should be able to get much more liquidity in the ETF itself, and there can be at least easier shorting. And at the time when they launched, they actually had quite a big pickup in AUM. I think it has kind of stalled over time, so maybe the interest isn't as high anymore. People have found other ways, but it is an interesting new idea. But of course, on the other hand, it means that your sector ETFs won't track exactly the indices that you might want to track. So they have a separate index which just of course has most of the stocks in it, but some are removed, so it's not exactly the same, and somebody needs to be careful depending on their mandate whether it actually makes sense to use those.
Yeah. And Irene, in your past experience, analyzing equity ETFs and index exposures, to what extent are some of the concentrations in some of the sectors a potential problem? Because clearly in certain European equity sectors, for example, you've got occasionally 1, 2, or 3 stocks with a very, very high weighting. So what do you think about that? Does that inhibit the development of sector products?
I think that's again always a problem. On the one side, for usage rules, you would like to have, or sometimes need to have them capped, like the 5-20-40 rule. On the other hand, if you're really having your strategy based on a sector rotation, you might want to be close to the underlying index, and therefore, if you have your sectors capped, then you can't easily replicate the underlying index and just have a tilt into some specific sectors, but actually have your portfolio mainly based out of the different sector ETFs. Right.
Michael, any view from you on concentrations and how product providers have dealt with those in the past, and variants of traditional index versions? We talked a bit about different classification systems. Do you think there'll be more index experimentation in sectors?
you know, it's also always a question of what's the benchmark. And if you look at the benchmarking in Europe, it is obviously very stocks related. Now, in that stock set, if you have things like media, it's not just the concentration that is a problem, it's also the liquidity that you're going to end up with, because an ETF will always only be as liquid as the underlying market that it's tracking. So it's a question of, you know, how much sense does it make to bring an ETF on something that is probably as a whole not liquid enough to accommodate, if it becomes a popular product, the amount of assets it's going to draw. So that's one of the things you need to look at, and I think that was also one of the parts where, if you look at these optimized sectors to look at, you tend to strip out the less liquid stuff to get it in. But now if you're sitting with a sector that is very concentrated, it's very hard to strip out fringes because there are none. So you do have on the one side a risk on not being UCITS compliant, but on the other side, if you're going to have a sector that comprises out of 3 or 4 big stocks, you might as well then just buy the 3 or 4 underlyings directly and not bring it as an ETF. So there's very little added value in wrapping 5 stocks versus 100 or 150, something to that tune. And then it's also a question of what is the commercial viability of bringing a product where nobody's ever going to really be interested in. So unless you have a dedicated sector allocation model which takes everything, and usually people are happy to go with sort of utilities, telcos, staples, materials, and such things, and they tend to be big enough and diverse enough to do it. Now, I've never been approached by anybody asking for leisure or travel or something like that. So the overall market isn't big enough. These type of products probably wouldn't cover their costs for any of the providers, so people aren't going to bring them. And apart from that, there's very little out there on the sector side that hasn't been done, unless you start looking at sectors which have a sort of a built-in alpha type thing, stuff like RAFI or Barra indices or things like that. But there we tend to find that, at least in Europe, people use ETFs as market access rather than as market strategies.
Yeah. What kind of, let's talk a bit about emerging markets, because you've got a range of emerging market sector ETFs. What's the take-up of those been like? And I mean, in general, does it make sense extending the sector principle to emerging market stocks?
It doesn't so far that when we started off on the emerging markets, we had an MSCI EM and sort of the 4 major regions, and that was all that was available. Then a lot of people came up and say, we don't want India, or we want China, or we want LATAM. And once that was done, we found that in the more developed markets, people have moved far more towards sectors as well, because they want specific thematic exposure. And we brought them because we were asked by quite a lot of people to have them. Now, as usual, once you start off with them, it takes a while for them to build up. Now, we've seen a fair amount of single thematic interest. So things like consumers. Everybody wants to play the emerging market consumer. People are a little bit more reluctant to play the emerging market what do you call sort of basic resources, metals and mining, those sort of things, because you can play that very well by countries as well. If you want to play oil, you play Russia. If you want to play commodities in a broad sense, you can go to China and so on. So it's a question of sensibility, but from a viewpoint of completeness, we think you need to have them because it gives investors a little bit more granularity, and the views are becoming more specific, and we actually seeing more sort of single stocky type investors going towards sectors rather than at the moment the more broad-based top-down investors are going to them. But I think it's probably going to meet somewhere in the middle. We're happy with the take-up so far. Probably could be a tad more, but we launched them sort of in a time when people were quite reluctant to go into equities as a whole. Yes.
Well, Irene and Russ, any views from you on extending equity sectors or the principles of equity sector investing to emerging markets from the developed markets we've all been focusing on?
Yeah, no, I think there's excuse me, Irene, I'll let you chat a second here.
Go ahead.
I'm sorry. Yeah, no, I think there's a great demand for that, and we found, at least with the existing sectors that are out there in the EM space, that our modeling does quite well. So it seems to be a needed innovation.
Yeah, I mean, from my point of view, emerging markets, it's a wide range, and it's many countries, and they're not all moving in lockstep. And therefore, some of the sectors make sense, like infrastructure or consumers, as Michael mentioned. Others, it seems, it just goes too far down in one sense in the granularity, whereas actually you would first need to go into different countries, for example, and then if you wanted to, you could go into sectors there, but then it just doesn't, it's just not liquid enough anymore, at least at the moment. So I think some sectors make sense for emerging markets because, I mean, what we're seeing is kind of at the beginning everybody wants to go into emerging markets, then it goes into countries. Now it's kind of some of the sectors as well. But to do kind of a normal sector rotation as one might do for the developed world or even a region like the US or Europe, I think that's much harder for emerging markets, and a lot still needs to be done on a country by country or at least regional level.
Okay, thank you very much. Michael, a question on other asset classes. What about extending the principles of sector investing to corporate bonds, for example? Are we going to see more products in that area, or is that another potential area where liquidity is a potential problem?
Well, liquidity is probably the key word there. We've gotten so far on the corporate bond world, and again, you know, any discussion in the sectors, you never get around financials, but it's basically we've cut most of the indices across providers in half. So you have sort of an iBox Europe corporate bond, and then you have two subsets, the iBox non-financials and then the financial. And if there's other indices being used, it's a very similar thing. So at the moment, it's still very much financials, ex-financials. Become more granular, going more towards utilities and things like that. I'd be a bit surprised. I think what you will get is a more granularity in terms of investment rating rather than in terms of the sectors themselves. Because on the bond side, the dynamics are a little bit different than on the equity side, and what you will find is that people will look for high yield or AAA rather than looking for bond sectors as such.
Right, so people are still focused on credit ratings primarily, and their mandates may dictate that, and they'll look at other things later.
Exactly, and probably regions or currencies as well. You know, you would rather, you know, the next step would be getting emerging markets corporate bonds, for instance, rather than getting, you know, splitting up the European or the US ones further. And obviously the other side is some of the sectors would have two players with a lot of issuance and nobody else has any. So it's going to be a little bit difficult to get the liquidity right because it's already difficult on the broad indices. So the indices would tend to be too concentrated, and you're going to always run into, at least on the UCITS side, you're going to run into trouble with the regulations.
Perhaps, Michael, a final question to you. We're close to the end of our hour, but now how big a percentage of the ETF industry in Europe do you think sector ETFs will represent in 5 years' time? Is it going to be growing as a market? Its market share, is it going to be pretty much where it is? You know, how much interest do you expect to see?
I think it's going to have significant growth because what we're seeing at the moment, at least, is the market is very sentiment driven, and it's going to be around macro themes. It's going to be about who's going to be the winner of, you know, whatever's happening on the big picture side at the moment. And because people want to get instant access to what's the right thing to do, is you're going to go either on a broad index, or you're going to, if you want to go in quickly, you're not going to do the homework on, you know, which is the best of the breed within a sector. You're just going to go for the sector straight away. In terms of how many new products have come out, I can't imagine that they came out because there's no demand from end investors for them. As they grow, there will be more models and more takers, and what we're seeing is an increasing amount of sort of multi-asset, absolute return type vehicles, which actually do cross-asset, cross-regional investing. So they can actually invest into anything out there, and sectors are going to be one of the big themes out there.
Yeah.
So I don't want to guess how much, but I think it's going to be much bigger in 5 years than it is today.
Okay. All right. Well, Russ, Michael, and Irene, thank you very much for participating on the panel, and Russ for your presentation. I'd like to thank everybody listening in for participating in the webinar as well. One final points, I'd like to, when you close your WebEx screen, a survey will pop up which will ask you to give your thoughts on what topics we should be covering in the next year of indexuniverse.eu webinars. It'll take you just a few minutes to fill in. We'd be very happy if you could help us in giving your views on particular topic areas for future webinars. With that, thank you very much. Have a good rest of the afternoon.